Welcome to the presentation of How to Buy Without the Why, First Time Homebuyers Edition. We are so excited to have you here today as you take this important step towards owning your own home. I'm Missy Crowley, and I am the office manager at MMS Mortgage Services. There's Paige Crowley, and she is the social media marketing coordinator. We have Chris Pugh. He is our senior loan officer and your loan representative at Educational Community Alliance Credit Union. MMS has been a partner with Educational Community Alliance Credit Union since 2018, and we've been doing lending right since 1987. Today, we will guide you through the home buying journey, breaking it down into manageable steps so you can feel confident and empowered to make informed decisions. Whether you're just getting started and exploring or ready to dive in, we hope this webinar will give you the tools to give you the insight that you need. I'm going to turn the presentation over to Chris Pugh. Go ahead, Chris.
Thank you, Missy. Hello, everyone. Again, thanks for joining us today. My name is Chris Pugh. I'm a senior loan officer with Member Mortgage Services and your loan representative there at Educational Community Alliance Credit Union. So I'm going to go over a few things for you, breaking up into three sections. So why you should buy versus renting. Information that you should know as a first-time home buyer to see if you are ready to purchase a home. I'll go over information that you should be aware of, and then how that translates into the types of programs that might be available for you that we offer through the credit union. So why should you buy? If you are currently renting or perhaps even living at home still, the average rent in the Ohio area, I looked at this information here not too long ago, the start of the year. Apartments rent averages right around $882. Condos are roughly $950, and a home is roughly a little over $1,000 a month. This is in the greater Toledo area. So you might be thinking, you can't afford home ownership. You're looking to afford rent perhaps, but home ownership may not be as far off financially as you might think. For example, if you look at a $150,000 home price, if you have 20% down with an interest rate of right around the average 6.75 is where the market is kind of on average for a 30-year, that principal and interest payment is $1,128. So it's not too much more than just renting a home, as you can see. And for an apartment, it's only a couple $100 more than owning or renting an apartment. So really far as financial numbers go, if you're renting a home right now, you're not far off at all from, to afford a home. One thing to take in consideration, of course, the principal and interest payment doesn't increase. It's fixed throughout the mortgage. You do have tax and insurance, and those numbers, those amounts do go up year after year as determined by the tax authority or your insurance. So there is some fluctuation there, but your principal and interest payment stays the same. So why should you purchase? So purchasing a new home, it's an investment. It's no different than investing in the stocks or your 401k. You're putting your money into an investment that will grow your money. There's equity building when you purchase a home. So if you purchase it today, say $150,000, 5 years down the road, it might be worth $200,000 or more, depending on the market and where you live. So you can then sell that house to buy something different, move someplace, and you have equity in that home that you can transfer over to your new home. So it's basically, it's like a savings. It's an investment. So you have that when you own. There's also freedom of living. I mean, who wants to be told what they can and can't do with the space that they live in? So unlike renting, you can do what you want to your house. You can paint your walls, you can update it, put nail holes and hang pictures and not have a landlord saying, hey, you can't do that. So owning your home gives you freedom, which is a very nice aspect of home ownership. Again, it has a fixed mortgage payment that doesn't change. Unlike rent, it goes up typically year after year. And of course, there's tax benefits where you can write off your property taxes. So there are some tax benefits as well for owning a new home. next step for someone who's thinking about buying is you want to make sure you have a good partner that you're working with, a good lender. And that's what we will provide for you. That's what I'll provide for you through the credit union. Very experienced. I've been working in as a loan officer for over 10 years. I know the ins and outs. I can educate you throughout the process, much like we're doing here. You want to have good communication. And again, you want that loan officer to be able to educate you. It's more than just working you through the system, getting your house, and that's it. You as a homeowner need to be educated through the whole process so you understand what you're doing, where your money is going, and are you able to afford it? There's one thing to afford and one thing to be able to pay it. So, we can talk about those two distinctions as we go along. And we are invested in you and your growth because you are a credit union member. That's what you deserve, and we want to make sure that you succeed. You're going to get in a pre-approval. You go through the pre-approval process, and there's some items that we will look at, and I'll explain to you about what gets you that pre-approval. And of course, you always want to have a good realtor working for you. You want what's called a buyer's agent. There's two types of agents out there. There's a seller's agent. That person will represent the person who's selling the home, and a buyer's agent that represents you, the buyer, and you want a buyer's agent. That buyer's agent will be working specifically for you. So what should you know about your pre-approval? Even before you come to your loan officer, or to me, you should have a good understanding where you are with your credit. There's things that you can look at. Credit Karma, if you have a credit card, a lot of times they have a credit score on there that you can reference. The credit union may have something that helps you understand what your credit scores are. That's a good place to start. They're not always as what they're going to be when a lender pulls your credit, because they are factored differently and that score is scored differently, but it does give you a good idea of where you are on the spectrum of credit. So roughly speaking, 680 or higher, you probably going to be a decent candidate for lending. You can go lower than that, don't get me wrong, but for someone who's just getting started out, if you're a 680, don't be afraid. You're probably going to be able to find something even lower, but that's kind of just like an average. How much do you need to purchase a new home? You can go down as low as 3%, 3% of the purchase price for a purchase of a home. And then there's closing costs. So for instance, if you're looking at, say, a $10,000 or $100,000 house, make the numbers easy, you're probably going to need, with 3% down, roughly $10,000, $11,000. So roughly, if you want to put in a percentage on 3% down, 10, 11% of the purchase price, it's kind of a good average. Of course, you'll need to have employment. 2-year history of employment is what lenders look for, and we'll break that down further on. And the type of house that you're buying does matter, and we kind of will touch base with that as well. So what am I going to look at? What are lenders going to look at when assessing your pre-approval and your ability to afford a home? We're going to first pull your credit. What does your credit tell the lender? What it's going to tell us is, what are your 3 scores? We're going to do what's called a tri-merge credit score. There's 3 scores that are pulled. Each agency, there's TransUnion, Experian, and Equifax, they all score differently. So we're going to take the middle score. That's going to give us your credit score. Every loan product out there, there's a minimum credit score. That's a hard stop. If you don't have that credit score, then most likely you're not going to qualify. It's got to be, say, 620 for conventional. If you don't have a 620, you're not going to be able to go conventional. So that's where it's going to give us the information of what type of product you're going to be able to look for. It's going to give us your credit liabilities, your debt load, whether it's credit cards, student loans, personal loans. It's going to tell us if you have any auto loans, any other mortgages, typically bankruptcies, money judgments, things of that nature. With your assets, there's different types of assets. There's funds in your checking and savings account. Those are obviously assets we can use to purchase a house. If you have retirement funds, we can use 401k money, IRA funds. You'd want to check with your manager of those accounts to make sure how you can draw them out for purchase of a home. There could be tax implications on IRAs and things of that nature. So you just want to talk with your financial advisor if you're going to pull funds from those accounts to purchase a house. And you could use gift funds from a family member, a mom and dad, grandma and grandpa. They can gift you funds for the entire amount for the down payment and all your closing costs. So there's different options there that you can look at. One thing to note, if you have cash money, those funds, if they're just sitting at home, it's called mattress money, if you will, those funds are not available for the purchase. You would have to put those funds into your account, and minimum they'd have to season in that account for 30 days prior to being able to use for the purchase of a home. If you're going FHA, they have to be in there for at least 60 days. So there are some requirements there with liquid cash that you have at home. You're going to want to get those funds deposited as soon as possible if you're going to use those for the purchase of your house. Employment, the capacity to repay. Obviously, you have to be able to repay that mortgage, correct? So there's a couple different types of employment, and then of course you have schooling as well that can help with that 2-year time frame history that lenders require. So if you are a 2-year full-time employee, which means your hours don't fluctuate. So you may work at a place and think you're of yourself a full-time employee, and you might be, but your hours fluctuate. So that does require a full 2-year history because we have to average it over 2 years. If you are a full-time employee, meaning your hours are set 40 hours, then we only need your paycheck and your last year's W-2. But we still have to have a history of 2 years. It's just less documentation. So the fluctuating income, the second bullet point there under capacity, that is when your hours fluctuate from week to week. And we do need a 2 years worth of W-2s and your most recent pay stub so we can, again, average out what that average income is over those 2 years. If you are self-employed, you have to have a 2 years tax return because we have to make sure that your business is thriving, it's improving year over year, and they're going to take an average over the last 2 year tax returns to establish what your income is. If you happen to be a recent graduate from college, if you have a 4-year degree, say in teaching, and you just started your teaching job, and like, oh, I got to wait 2 years before I can buy a house, you don't have to. With school employment, typically it's a salary job, so we know exactly what you're going to get paid. Your 4-year degree is going to act as a 2-year job history, so we just need to see that you are currently employed, get your first paycheck from the school you're working for, in that case, and you are fine to proceed with your purchase. Your 2-year degree is worth 1 year's worth of work history, and then as long as you're at a full-time position working 40 hours a week and your hours are consistent and they don't fluctuate, then we just need 1 year of employment, so a W-2, and then your pay stub. And of course, with the last item that we look at is the collateral, which is the house, the type of house that you're buying. Single-family homes, condos, new construction, manufactured homes are properties that are available. With manufactured homes, they can't be built after I believe it's 1978. Anything after that, anything older than that are not eligible. They have to be a double wide type of manufactured home, and they have to be on a property that you own. So you have to own the property, can't be in a mobile home park. Those are some restrictions around a manufactured home. So if that's something that you're looking at, you're going to want to make sure that it is a home that is approved. And there are single family homes that might be fixer uppers, but they might be more than just cosmetics. I mean, if it's a house that's pretty much ran down, it's not going to qualify. So that's what I'm talking about with housing eligibility. It has to be a home that is eligible. Think of it as you can just move right into it. You may have to paint it, fix it up a little bit, but everything works in the house. So that's kind of how you can judge that. So what types of loan products do we offer to you through the credit union? The first one, we have conventional loans, FHA, VA, USDA, and renovation loans. So the conventional loan is the first loan product that we'll talk about here first. The minimum credit score is a 620. So if you have a 620 or better, you may qualify for this loan option. There is the option of going down as low as 3%. That's the first-time home buyers program. It is income-based through Freddie Mac and Fannie Mae. They both have their own first-time home buyers qualifications. It's income-driven, which you can find online. So you can kind of look at it if you want to know if you qualify for it. You just go to like Home Possible. That's Freddie Mac. Type in Home Possible income limits. You type in the address, and it'll give you the limit for you. And you cannot have owned a home in the last 3 years. And then there's a online course you take. It's not very long. You take the course, and then a certificate is sent to me, so we know that you've taken the course, and then we just go through the loan process. It's a nice program for first-time home buyers because, again, it allows just 3% down. There is mortgage insurance. For those who may not know what mortgage insurance is, it is an insurance policy that you pay for. It's a premium you pay for, but it covers the lender. So it allows you to purchase a home without putting 20% down. It covers that, in this case, 3%, covers that 17% that you're not putting down in case of default to the lender. So that's what that mortgage insurance is for. And it does drop off after 10 years on a conventional loan. Seller concessions. There are seller concessions that you might be able to get and negotiate with the seller to help pay for your closing costs on the conventional loan. It's up to 3%. FHA, the typical minimum credit score is a 580. However, there are some exceptions to that. If you have 10% down and your scores are as low as 550, you still may qualify for FHA. If you're looking to put just 3.5% down, most likely it's going to be difficult to potentially get an acceptance at the 580 credit score because there's layers. There's risk factors, right, for every person. So these are just the minimums, but depending on your overall picture, you may or may not qualify. And for the 550 credit score, you have to have, again, the 10% down. The mortgage insurance on FHA does stay on for the life of the loan. It does not drop off. Even if you were to put 20% down on FHA, that mortgage insurance stays on for 10 years, and then it does drop off. So 10% or less, that mortgage insurance will stay on for the life of the loan. But it is a smaller amount. It's a lesser amount than conventional. And it does allow up to 6% seller concessions, which is a nice aspect of FHA. So FHA is a good program for individuals that might not have credit up in the 700s, in the mid 600s. FHA is a great program. It does allow for debt ratios up higher as well. And typically the interest rates are just as good, sometimes even a little bit better than conventional. So there are some perks to FHA that still helps individuals get into homes. Our next program that we offer is for our veterans. It's the VA loan. You must be an eligible military service member or veteran. Minimum, again, 2-year work history or income. You may not be working if you're retired. Again, with any of these jobs or any of these homes that you're purchasing, if you are retired, of course, Social Security, pension, things of those nature, that type of income is also available. It's up to 100% financing on VA loans. So these are nice perks for our veterans. All you pay for is the closing costs. You don't have to have a down payment, and there's no mortgage insurance, and there's no minimum credit score. So the VA program is a great program for our veterans. There are some funding fees that you may have to pay for. If you are a disabled veteran, you don't have to pay that funding fee, and they do allow up to 4% seller concessions, which again is nice because then that helps with the amount of money that you have to bring to close as a veteran. So a lot of times you can come to those closings with minimum money out of pocket. It's a great program for their veterans. Another 100% financing option is the USDA loan, or Rural Development Loan. There's a minimum credit score on that one is 600. Again, income, 2-year work history if you're working. Their mortgage insurance is a little bit lower, but it does stay on for the life of the loan, much like the FHA. There's more layers to the USDA loan, qualifications. It is income driven, and they look at the entire household. So it might be just 2 people applying, but they're going to assess the entire household. Anyone 18 or older who's working, they're going to assess that income unless they are full-time students. It is properly located, as it's kind of stated there. It's a rural development loan, so the property does have to be outside of the urban area. And again, there's a property map online that you can look at, type in an address to see if a property qualifies. There's a funding fee, and there's max loan amounts that guidelines for this type of product as well. And there are 6% seller concessions, so that does help again with the overall cost, which allows a lot of times minimum money out of pocket for the home buyer. The last program that we have available is the renovation loans. It's through Fannie Mae, which is their home style program, and FHA has a 203K renovation loan program. And you can use those in combination with the low 3% down, which is really nice. You can, with the conventional Fannie Mae product, you can use it with their home style and the home ready. You can combine those together. What it allows you to do is if you're buying a home that is a fixer-upper, let's say, or just needs to be updated, you can have those remodel costs rolled into your mortgage. So if you're looking at a house that's $150,000 and you're like, man, I want a new kitchen before I move in, and it's $50,000, you can have that potentially rolled into the loan, and then your loan is going to be $200,000, as long as, of course, you qualify for it. And then there's steps to it, which I can get in more detail. If you call and you're looking, hey, I want to look at this option, I can go to more detail for you. But as an option to be able to remodel homes, update the interior, you can do landscaping with it. It's a great product to make that home yours even before you move in. Put your personal touches on it. So it's a nice program. I like to use that program for first-time home buyers. It makes them feel like they're buying a new home. And those are the 5 programs that we have to offer for you all. I hope that this was informative and you're able to take from this and kind of get started and realize that maybe home buying isn't too far off for you. You can always give me a call at my cell number listed there whenever you need. I'm available anytime for you to ask questions. And of course, if you're ready to actually do a pre-approval, be more than happy to sit down with you, talk with you over the phone, and get that pre-approval done. Thank you. Thanks for joining us, and have a great day.
Thank you. Thanks, Chris.
Thank you.
Thank you for tuning in, and I hope we hear from you.